Hello, welcome back to Learn Economia. Today we would be discussing certain investment related strategies to learn before trading. Many of you might be engaged in trading. We know that the secondary market has been gaining importance day by day. Secondary market with respect to financial market that I'm talking. So this is gaining importance. Most of us are engaged in trading. Most of us are owners of shares of different companies. So when we trade, what are the steps that you have to follow? Or before in starting our trading activities, what all the things that we have to understand? That is the subject of topic or subject of matter in this video. We'll be discussing that in detail here. So let's get started. Before going into the different kinds of investment strategies that you have to learn before trading, you have to see, first of all, what is an investment strategy. And this involves a set of principles which would guide you to make investment decisions. There are different kinds of investment strategies or different kinds of investment plans that would be helping you to make an independent decision with respect to making of investment. So you can follow different investment strategies, and this would depend upon your risk tolerance, the risk that an individual would be willing to take. That is something which differ from person to person, right? So some people will be very much risk averse, some people will be risk loving, some people will be in between these two categories. And coming to the investing side, this too is a factor that would be that would be influencing your investment plans. That involves long-term financial goals, the goals that you will be setting before making the investment. So this too would be different for different people. So actually all these things are some things that you have to take into consideration while you are going for an investment strategy. So investment strategies, you can see that all these things are flexible. It can be you can make adjustments here according to your plans, according to your needs, wants, etc. So if you choose one of the investment strategies that doesn't and it doesn't suit your risk tolerance, so then what you will do is that you would be shifting to another. Yeah, for example, if for example, just take the case that you have investment strategies from A to Z. So from these you would be picking one investment strategy. For example, you might have picked A. After some time, you could understand that this plan is not working. So that means that you would be leaving that plan and you will be shifting to some other plan like M or something, right? So however, we can see that changing these kinds of investment strategies involves a lot of cost. You would be incurring a lot of cost when you shift from one investment strategy to another investment strategy. That means that rather than shifting from one strategies to another strategy, it is better to learn all the strategies, to understand all the strategies first, and then pick the right one which suits all your needs. So each time you buy or sell some securities, especially if you're buying or selling in short term market, or if you're buying or selling in non-sheltered accounts, these things would be creating a lot of taxable events. So you would be liable to pay tax. You may also realize that your portfolio in many cases is riskier, but you might be preferring a less riskier portfolio, but what you actually have is a much more riskier portfolio, but you never wanted it. Here, what you have to do is that you should be looking for different investment strategies that would be suiting your plan, your needs, your wants. By taking the time to understand the characteristics of each and every investment strategy, I'm not telling that you must be having an awareness regarding each and every strategy that people use in the market, but at least you should be aware of some main strategies that people mainly use. So that is the subject of matter in this video. I'll be familiarizing you with certain main investing strategy. The first thing here is that getting started. So you have to go to research, then only you can actually, when I say research, it is not about spending years and years for this particular thing, but what you do is that you have to study the market. Before you begin to research your investment strategy, it is important to gather basic information about your financial situation, how much you would like to invest, how much, so that is very important. If you are a very richer person, then you might be investing a lot, but if you are in a moderate situation with respect to your finance, your plans might be a bit different. So you can ask certain questions to yourself. What is your current financial situation? Whether I am planning to invest amount X or Y or something else. What is your cost of living, including your monthly expenses and debt? So that is also something that you have to take into consideration, because everyday life involves a lot of currency transaction. Then you can ask how much can you afford to invest, both initially and on an ongoing basis. So the investment can be of different types. You can actually go for a one-time payment, or you can go for a regular payment, or it actually depends upon your convenience. Even though you don't need a lot of money to get started, you should not start investing until you can afford to do that. If you have debts or if you have some other kinds of obligations, then you need to consider the impact of investing. So what will be the impact of your investing on your debts, your obligation, other kinds of financial needs, wants, etc. Now it is time to set your goals. After answering the questions which I have already told you, and now you can set your goal. It's a time for that. Everyone might be having different goals. Everyone actually have different goals, right? Because my financial situation is not the same as the financial situation of Ambani. He is a very richer person, right? So so what I might feel is like, I will consider my standard of living, I will consider my cost, my obligations, debt, all these kinds of things into consideration. Then only I'll be making investment plans. So now you need to ask some more questions to yourself. Are you saving for retirement, or are you looking to make big purchases like home or car, etc. in the future? Are you saving for your child's education? So these all are the secondary questions that you have to answer before making investment. So why should you answer all these questions? Because when you answer these questions, this will be narrowing down your strategy, investment strategy. So because as I have already told you, there have been many or different investment approaches, or in many different investment strategies or plans available. So you would be actually choosing the perfect one for you. So in order to make the plan perfect for you, what you have to do is that you have to answer all these kinds of questions, then pick the right strategy, narrow down your options, and then pick the right one, right approach or strategy for you. Now, what you have to do is that figure out your risk tolerance, whether you are risk averse or risk loving, or whether you are between both risk loving and risk averse category. Your risk tolerance is very much important here, and this is determined by two important factors. First is that this is normally determined by uh, certain factors like your age, your income, how long you will be having uh, from now to retire. All these kinds of things are there. Your age is definitely a factor, whether you are in the 60s or 50s or 40s, and your income, whether it is above 20,000, whether it is above 60,000, all these things also matter. Then investors who are younger, they have time on their side to deal with their losses, right? And so it is often recommended that younger investors are more risk they are most risk loving than the older people, because they have some time. I'm not telling that the older would be dying first and then younger would be dying. I'm not telling that, because we cannot predict our lives. Anybody can die anytime. Even a 1 year old child can die, or a person can die before his or her birth. So I'm not telling that in that manner, but usually people would think that um, uh, younger generation, they have more time to spend on earth. So as a result, they would be making their plans accordingly. But nobody can predict anyone's death. That is something that we have to consider as a universal truth, and I'm not getting into that. But let's see, this is something people consider as a usual case. That's it. Now coming to the case of risk tolerance, again, that is whether you are risk averse or risk loving, or in between these two, right? Since it is a factor that is very much important here. Now you can see that this is something highly psychological, because this is something which plays a very important role when it comes to your emotions, when it comes to your obligations, when it comes to your duties, responsibilities, all these kinds of things in your life. So again, some more questions you have to answer. How would you feel if your investment dropped by 30% overnight? So you might be you might have invested your full savings on something, and overnight, in one night, some crash, one share market or stock market crashes happen, and it has negatively influenced your investment. As a result, it has dropped. uh, your profits has become your losses. So this all these things have happened in one night. So if such a thing happened, then how it would affect your uh, future prospects. So this is very much important. You have to answer this question also, how it would be influencing your future prospects. And also you can answer, how would you react if your portfolio is worth $1,000 less today than yesterday? So when you're making investment, it is a 50-50 chance. Either you can make profit or you can make loss. Sometimes the best strategy here is to make money by making like by making people emotionally uncomfortable. Sometimes it's better to make money by making people comfortable, right? So if you're constantly worrying about your financial state, or you are actually worrying about the chance of losing money, then it is better for you to invest in those strategies that are less riskier. If you are worrying about all these kinds of things, that means that you are a risk averse person. You are actually afraid of risk, you fear risk. So it is not for you to invest in riskier alternatives. So just stay away from risky alternatives, and you can invest in risk less alternatives. Now, the final question here is that the final thing is to learn the basics of investing. So you have made all your plan, you have answered all the questions which I have given you. Now you can make your you can make your lessons. You can actually learn from the basics of investing. How can you learn? You can read the stock charts. You can begin by picking some of your favorite companies. You can analyze financial statements of these companies. You can keep in touch with the recent news about the companies that you are planning to invest. Then, or you can actually get in contact with your friends who already have a good information related to the financial market. So it's a good idea to have a basic understanding of what you're getting into, so you are not investing blindly. So having all give you a very detailed intro, now it's time to look into strategy one. So what is the strategy one? It is known as value investing. Here value investors, they are known as a bargain shoppers. And what they do is that they seek stocks they believe are undervalued. They are not looking into stocks which are overvalued. On the other hand, they are looking into the stocks which they believe as undervalued. Here they look for stocks with prices they believe don't fully reflect the intrinsic value of the security. So, you might think this as an irrational act, but it is not so. It presents a lot of opportunities actually. It is not necessarily for the value investors to comb through the volumes of financial data to get deals. We can see that thousands of value mutual funds have investors the chance to own a basket of stocks which they thought to be as undervalued. Here you can see the example. I'm not going into the examples. You can read the examples here. You can see that for those who don't have time to perform exhaustive research, so you don't have time to collect market data related to the movement of the company that you are planning to invest in. Then what you do is that the price earnings ratio has become the primary tool for quickly identifying the undervalued or cheap stocks. So when you don't have time to look into the market data, then just go and look into what is known as the uh, price earnings ratio. Okay, and this is a single number that comes from dividing a stock's share price by its earning per share. Here, how can you interpret the data? A lower price earning ratio would give you uh, an idea that you are paying less per $1 of your earnings, and value investors see companies with a low P by E ratio, a low price earnings ratio. Now, the second strategy here is growth investing. So, having understood value investing, let's come to the growth investing here. Here, it's better to deal with some kinds of differences. So, many people we can see that, especially who are growth related investors, they rather than look for low cost deals, these people they want investments which offer strong upside potential when it comes to the future earnings of the stocks. So you can see that growth investing uh, involves looking for the next big thing. So this is a main tag that a growth investor is assigned with. So or he or she would be actually carrying this tag, and we can see that even though this is the case, it is not a reckless impulsive speculative investing. On the other hand, this would involve evaluating a stock's current health as well as its potential growth. Here, a drawback to growth investing is that a lack of dividends. We know that lack of dividends is something that every investor would be actually looking for, because it involves some kind of regular payment. I'm not telling that every dividend would be regular, but mostly we can see that the dividends are mostly regular. So here you cannot see dividends. If a company is in growth mode, it often needs a lot of capital because it is actually expanding, it is trying to expand, and it would like to sustain its expansion as well. So this does not leave much cash for dividend payments, or that cash too would be taken for the company expansion. So the shareholders won't be getting dividends. We can see that moreover with faster earnings growth, uh, there would be higher valuations, and as a result of higher valuations you would be getting dividends in the future. But for the time being you have to be very patient, because at least by now you won't be getting dividends, but you will be getting that in the future. Moreover, with faster earnings growth comes higher valuations, which are for most investors a higher risk proposition. And while there is no de facto list of hard metrics to guide a growth strategy, there are a few factors an investor should consider. So what all are the factors that you have to look into? You have to see that the growth stocks, it can have a chance to outperform during the periods of falling interest rates. And it is also important to understand that the first sign of a downturn would be something uh, which would be hitting the stock of a company or share of a company. And the growth investors they need to be very much careful when they consider the management prowess of a business executive team. So they have to achieve growth in a most difficult manner and the most difficult challenging times for the firm. So therefore a stellar leadership team is very much required, and investors should evaluate competition. A company might enjoy stellar growth, but its primary product is easily replicated, and here you have to consider the case of long term. Coming to the case of momentum investing, having discussed the value investing, growth related investing, now it is momentum investing. So these people who are momentum investors, they believe that winners keep winning and losers keep losing. So that is their ideology, and they look to buy stocks experiencing an uptrend. Why they do is because they believe that losers continue to drop. Once they drop, every time they drop. So that's the case. And these people, they are heavily reliant on technical analysts, and they use data driven approach to trading, and they look for patterns. They actually look for patterns of stock prices in order to guide them to get their purchasing decisions. And this will be giving them additional weight regarding how a security has been trading in the short term market, or in terms of short term trading. And these people, they act in defense of the efficient market hypothesis. That efficient market hypothesis is a separate thing, a separate theory actually. I'll be discussing that in detail. And actually these momentum investors, they follow this kind of efficient market hypothesis theory, and they believe that winners will always win and losers will always lose. That's it, and they will be using the market driven approach. And this theory, this efficient market hypothesis theory, it actually states that asset price fully reflect all information available to the public. And here you have to understand that people who are familiar with econometrics might be knowing, whenever we build a model, actually we would be leaving certain factors, we would be actually avoiding certain important factors, and that is not a deliberate attempt, but it will accidentally happen. As a result, the error term would be capturing, our error term in our model would be capturing all these kinds of things, and it would be affecting the result of the result when we are running of a model. I mean, when we are running a model, the result would be capturing all the error terms, and it would be reflecting that. And as a result, your model would can uh, wrongly depict the normally depict the real conclusion. I mean, the conclusion you receive would be a wrong thing. So here also the same thing happens. Even though we consider that the asset prices would be taking all the available information from the market, uh, it cannot be the case. There can be errors. A moment an investor believes that given all the publicly disclosed information, there are still material short-term price movements to happen. Markets aren't fully recognizing recent changes to the company. So these are the cases, and also if you are taking into a case of externalities, as we have already discussed, externalities is something which cannot be priced or which cannot be taken for the calculation of cost. As a result, even though all these kinds of things too would influence your share prices, actually things cannot be priced. So that is a very a challenging thing that you have to deal with. So despite some of the shortcomings here, momentum investing has its own appeal, because if you consider the case of an example, that MSCI World Momentum Index, which has average annual gains of 10.75% since its inception in 1994 uh, through June 2022, compared to 7.59 for its benchmark of the same period. Now, having discussed the growth investing, the value investing, the momentum investing, now come to the fourth and important thing, that is dollar cost averaging, another strategy to deal with your share market. And this is a practice of making regular investments in the market over time, and this is not mutually exclusive to the other methods that we have already discussed. uh, it actually means an a kind of executing whatever strategy you have already chosen. Okay, and with this particular strategy you might be choosing to put some amount in an investment account every month, and this disciplined approach involves powerful mechanisms when you use automated features that invest for you. Okay, and this is something which avoids painful and ill-fated strategy of market timing. If you are going for seasonal kinds of investments, we can see that even seasoned investors, they occasionally feel the temptation to buy when they think prices are low, only to discover to their dismay they have a longer way to drop. And when these investment happens, especially in regular increments, you can see that the investor captures prices at all levels from high to low. And if you are going for periodic kinds of investment like a dollar cost averaging, these periodic investments effectively lower the average per share cost of the purchases. As a result of that, it would be reducing the potential taxable biases for future share sold. So these are the main strategies that you can take into consideration. So I think I have given you a very brief idea, even with respect to the 4 different types of investment strategies that you have to consider while going for investment. So before actually when you are going for investment, you have to answer the questions which we have already discussed in the initial part of this video. That is very much important to make you understand that whether you are fit for making investment at this point of time. If you are not fit, if you think so, then you can postpone your plan for making investment in the future, either in the near future or in the distant thing. That's all for today. Please like, share and subscribe to this channel for more videos, and you can be a part of my Telegram channel and Telegram group to discuss your doubts. So we'll be seeing in the next video with a very novel topic with respect to investment related aspects. Again, it is actually many people were discussing, many people were requesting to me to make videos related to investment. That's why I have taken this topic up. So if you want me to discuss any of the economics related topic, I'll be taking it up. Please comment that in the comment box. And that's all for today. And you be a part of my Telegram channel and Telegram group. You can be a part of my Telegram channel and Telegram group by clicking the links given in the description box. That's all for today. Bye.